Okay, good afternoon, everyone. Today is the 4th of September, 2022, which is on Sunday. And we will be starting a new journey, which we'll be talking extensively on income taxes. Okay, we'll have a discussion on income taxes with respect to IAS 12. And also, we'll try to also make one or two discussions on IFRIC 23. Okay. And this will take us through some little journey where we'll be extensively discussing certain principles and concepts or practices with respect to income taxes. Okay, and all of what we are going to discuss will be solely with respect to IAS 12 and probably an extension of it to IFRIC 23. Okay, when we talk about income tax, invariably, what are we talking about? Those are the things we are going to more or less take our time to have discussion on today. Okay. Now, we're making use of this presentation slide, and also we'll develop models to which we are going to carry out our tax computations as we begin in our discussion on this section or program. Okay, now I think it's about time for me to share my screen with respect to what we'll be discussing upon. Okay. Okay, I believe we can see my screen.
Yeah, I can see your screen.
Okay, this is screen. I'm trying to more or less display to you guys. Okay, as we'll be discussing on this, we'll be looking at the objective and importance of IAS 12. Okay, when we look at IAS 12, the standard more or less wanted to make us have a better understanding about the accounting treatment for income taxes, and also try to reduce any possible distortion that may arise from the performance of an entity with respect to how income taxes impact those performances as reported in the financial statement. Also, this will make us understand that there are two perspectives to which income tax can be viewed. We will consider the income tax perspective that borders on current taxes, and the other perspective that borders on deferred tax. And we're going to look at both perspectives as it is. But the perspective that is much more common and known to people is the current tax perspective, whereas very few more or less have proficiency and also understanding about the logic that gives birth to deferred tax recognition. And also we'll look at what constitutes deferred taxes, what are the things that give rise to deferred taxes. We'll look at the methodology and school of thought that exists with respect to recognition of deferred tax. Those that consider deferred tax recognition in full, those that consider the recognition in part, and those that do not consider its recognition at all in order to make tax reporting more simplified. I will also look at the position of the IASB as contained in IAS 12 on which of the methodology or school of thought is more appropriate and what we need to adopt. We'll look at all of these things in the course of our discussion. But before we delve into aspects of deferred tax, the first and primary understanding must be gotten from the discussion we will have with respect to current taxes. And we'll try to delineate what constitutes current taxes. And we'll look at it within the Nigerian context. What are examples of taxes that will have constituted an income tax? And what do we consider other forms of taxes to be? Are we going to say they are more or less transaction taxes? Or what are we going to consider them as? And also, how do we recognize transaction taxes other than income taxes? And how do we recognize income tax in our books? And what other form of disclosures or limitation exists with respect to income taxes? All of these things are what we are going to discuss in the course of our discussion. Now, I'll open the floor if you have any contribution with respect to expectations that you may have with respect to what we want to discuss, and areas of concern or areas of concentration that you will have appreciated more based on your experience as a professional and qualified accountant or tax practitioner, as the case may be. I'll give you 1 or 2 minutes to make such contributions before we forge ahead. Over to you guys. Thank you.
All right, thank you very much, sir. Quite well. To me, I have a little understanding as regard the income tax. What gives rise to taxable temporary difference? What gives rise to deferred tax? What gives rise to deductible temporary difference? Deferred tax.
Okay, any other person, there's a background noise there. If you have a background noise, probably you should try and move away from there, or probably send a chat and I'll address your chat. Okay, any other contribution with respect to what your expectations are, what your concern is, so that that can also be incorporated in the whole of the discussions we'll be having forthwith. Is there any other commentary? Okay, if not, we'll move on. Now, as I've said earlier, that income tax comprises of current taxes and deferred tax. And therefore, we'll look at it that what constitutes a current tax and what constitutes a deferred tax. Okay, when you talk about current tax, we are more or less looking at, in principle, taxes that are based on, those are considered our actual taxes in this case, and they are based on various tax laws that relates to corporate taxes in the jurisdiction in which a company operates. For example, if you look at Nigerian context, current tax will be actual tax payable to the relevant tax authority as regarding the tax due on all various forms of profits of an organization. And in Nigerian context, all form of taxes that is levied on the taxable profit or different aggregate level of profits in Nigeria is usually payable to the Federal Inland Revenue Service. Okay, as opposed to other transaction taxes that might cut across other taxing authorities. Whereas when we look at deferred tax from another angle, deferred tax then relates to future taxes that may be ascribed to similar transactions that are giving rise to current taxes, which means not necessarily will all the tax consequences of a transaction that gives rise to taxable profit may be captured in the current period by way of current taxes or by way of actual taxes payable for that relevant period. Rather, there are some other components of the tax that may be due in future as a result of the differences that may occur between the tax recognition of a transaction with reference to how it gives rise to taxable profits and accounting recognition in line with the requirement of IFRS towards when and what period do we recognize the transaction as it impacts our accounting profits. But before then, we need to more or less emphasize on what constitutes an income tax and how does income tax differ from other forms of taxes. Or let us say, what is tax in its own respects? I believe we need to start from that point. What is tax? Let us pretend as if we have no idea of what tax is. And let us start to delineate what do we consider as income, as tax. And from there, we can more or less look at taxes from different perspectives. Okay, now what can I do now is for me to I'll more or less share my screen. Okay. Now let me pick my pen and let us try to begin our discussion as follows. Tax versus taxation. Now, what is tax? Now, when we look at tax, the following attributes are key to identifying what the tax is. The first thing we need to understand is that a tax is a compulsory levy. That's the first thing we need to know. And this compulsory levy, is it all or any kind of person, organization, or individual can levy such a tax? The answer is no. Therefore, it's a compulsory levy by who? By the government. Directly or through its agencies. Or through its agencies, which means any compulsory levy by government or through its agencies can be considered a tax, provided it is charged on a taxable person or persons. Now, who are these taxable persons? These taxable persons may include a body corporate. A body corporate is all what we know as companies. Individuals, which includes natural persons, partners in partnership, and proprietor of a sole trading business. And also levied on trustees in a trust. Okay. In this case, when we have these attributes, we say whatever the levy is, regardless of the nomenclature given, it will be considered as a tax. But let me emphasize, when you say compulsory levy, what does that mean? It means it is not contractual. It is not contractual, which means what is not contractual means you need not get a commensurate value or any value at all from the party to which you pay such an amount, or because you are only compelled to do so by instrumentality of the law. And that's why no one have a justification to claim that since I don't get social benefits, I don't get commensurate value from government or its agencies, and therefore I'm not going to pay tax. Rather, tax comes by way of compulsion. And there are two things you need to know in life. There are two things certain in life. Who can tell me those two things? 1 and 2. What are the two things certain in life?
Debt is certain.
Debt is certain.
Change.
What else is certain?
Change.
I can't hear you.
Made mention of change.
Change. No. Have you seen what's it called? Cellulose sugar.
Tax is also certain.
Have you seen cellulose sugar before? Cellulose sugar, since I was born, they've not made any changes to it. Neither have they changed the carton or packaging or brand, which means change is not necessarily certain. Rather, change is a constant factor, but not a certainty. Therefore, somebody mentioned something. After that, the next certain item are taxes. And that's why in 1716, I guess, Cover of Pristine, which is a book, The Cover of Pristine by Christopher Bullock, in 1716 talks about it's impossible to be sure of everything, but at least you are sure of debts and taxes. Also, Benjamin Franklin, in his letter to James Baptist Leroy in 1789, he says our Constitution is not established and has an appearance that promises permanency, but in this world, nothing can be said to be certain except debt and taxes. I think Daniel Defoe, yeah, in 1726 also reiterated it in his book where he talked about the political history of devil, where he said things as certain as debt and taxes can be more firmly believed. Which means if you look at all of what we've discussed, you'll find out that debt and taxes are the two things that are certain in life. Now let's also buttress the compulsion attributed to taxes. And this can be referred from the Bible. And I think Matthew 22, chapter 22, verses 21 here, says as thus, that Jesus said, render to Caesar the things that are Caesar's, and to God the things that are God's. And the question then is, what are meant to be given to Caesar? If you remember, what is meant to be given to Caesar is a levy or taxes in which tax collectors, who are Caesar's agents, compel the people of Jerusalem to pay. And this also was buttressed in Romans chapter 13, verse 1, which says that let every person be in subjection to the governing authorities. For there is no authority except from God, and those which exist are established by God. And if you follow all of these doctrines, principles, practices, and rules, it makes it clear to us that apart from that, what other things certain till the world comes to end are taxes. And therefore, tax are rules by compulsion, whether it is fair or not, even though there are maxims that support taxation. But again, we'll look at that later with respect to economic prosperity, which also can be buttressed from what Adam Smith wrote in his book of those days when he talks about the wealth of nations. Okay, but again, we'll put that aside. But what is paramount is that every form of tax is a compulsory levy. You pay it first before you ask questions with respect to how judiciously are the government making use of the tax. Not that you ask questions first, how will you be using for me to pay next? If it will be contractual, probably we can have an argument to say, the one I paid before, how will you use them? But because it's not contractual, therefore, you have no basis in law or arguments to justify non-compliance. And that's why we need to understand this, which means the three key attributes of a tax is the one, it is a compulsory levy. Two, it can only be levied by government, okay, or its approved agencies. No more, no less, and it's always going to be charged on a taxable person, which means there can be some exemptions that can make you not taxable person, okay? But again, we'll speak to various forms of taxes, but every form of tax will either impact a taxable person being a corporate entity, a taxable person being an individual, or a taxable person being a trustee in a trust. Does that make sense? So, now, who can tell me what then is taxation? What then is taxation? Now, taxation. Okay, I think somebody wants to say something. If your background is less noisy, you can say so. Okay, Mr. Denny, over to you, sir.
Okay, sir. I think taxation is a fiscal mechanism by which government, raises revenue to fund the social amenities.
Okay, which means I can summarize as the process to which government administer taxes, which means the whole system of putting up a tax law, which means there must first of all be a tax law. No single amount of tax that can be collected or administered without being backed by law. Two, the process also entails having to formulate the process or the means to which taxes are collected, and also accountability of those taxes are taken into consideration, which means taxation is the entire process of tax administration, which entails formulation of the tax laws, application of the tax laws, collection of tax revenues, compliance processes, and issue of accountability, which is the whole gamut of a tax system that ensures all of what is required in tax administration is what we can consider as taxation. But the reality of today is that tax and taxation are used interchangeably, and we understand why. Tax is the result or the main objective to which taxation as a system is put in place. But to collect those taxes, you need to have a system in place, which is driven by various processes, as the case may be. What that means that in the course of our discussion, and also in reality or in real world, tax and taxation can be used interchangeably. And I think there is no crime about that. Thank you, sir. Now, let's now look further to say, how can I break down taxes? Taxes as basis. Now, what are the basis of taxes? The word basis infers that tax must be levied on something. Okay, what does that mean? It means the reference point to which tax is computed or charged is what we call the basis of tax. Tax might be based on capital. Tax might be based on revenue. Tax might be based on production, or what some people call output. Tax might be based on consumption value. Tax might be based on health counts. Tax might be based on assets. Tax might be based on costs. And let me put tax might be based on profits. Which means whatever the reference point is, we consider it as a basis of tax. Now, all of these bases I can group it into two. Basis that can be considered transaction taxes for financial reporting purposes, and basis that can be considered income taxes. Now, what we are coming to majorly is this. But before we get here, we need to understand this. Now, for example, we have taxes that are based on capital in Nigeria. Such taxes may include stamp duty. When a company registers capital, it pays stamp duty. Okay. Also in Nigeria, you have tax that is based on revenue, usually to regulatory agencies. For example, NCCN, I think, is 1% or 2% of the revenue from telecommunication companies. Such is a tax, but it's a revenue tax. What is generic in Nigeria before 1993 was sales tax, which is also revenue tax, before it was replaced by value-added tax in 1994, 1st of January. Tax can be based on production. For example, if it's production of oil, crude oil, it is known as royalties. If it's other production, like manufacturing, it's known as excise duties. Tax can be based on consumption. And in that case, you can have tax such as value-added tax on goods and services consumed. Tax can be based on head count. For example, business premises levy for the number of premises you occupy as a company. Can also be based, even though the tax in that case is supposed to be borne by employees, but again, the body is usually transferred to the employer. and that is the state development levy, which is charged at 100 naira per staff. That also comes here as headcount. Tax can be paid on assets, whether by way of importation or even when it is not imported, it's something you have in Nigeria. For example, you pay tax on your vehicle, on your property like tenement rates, like TV license, radio, all sorts of assets and introduce tax. Okay, you also have tax on general costs in various ways. Some might come by way of VAT, some might come by way of stamp duty, some might come by way of production, and etc. And lastly, we have tax based on profits. Now, what is unique about it? All of these bases of tax are considered to give rise to transaction taxes, except for profits. Which means it's only profits that will give rise to income tax. Therefore, that will require us to define what profit is for tax purposes. What is profit for tax purposes? It's simply the matching of income with cost, or if you want to say expenses. I want to talk about profits. Relatively, we are talking about taxable profits. Now, what can taxable profit take as a form? Taxable profits can take any of these forms. Can be any of the following. Can be total profits, as known to things like CIT, Company Income Tax, and PPTA, Petroleum Product Tax Act, which can now be replaced with the PIA. Well, we're talking of hydrocarbon tax, HT. It could be chargeable profits, which is usually known within the CGTA, Capital Gain Tax Act. It could be assessable profits or adjusted profits, which is still known through the Tertiary Education Tax Act, CETA, which we can use in conjunction with PIA. It could be gross profit. As you know in accounting, what gross profit is. It could be operating profit. It could be net profit, or what some people call accounting profit. That's the last level of profit in accounting, which is also used by things like information technology development levy and the like. Which means, what is profit? Profit is simply taking all of income minus all of expense, or part of income minus part of expense. Once there's a matching, as you have it here, that is, once you offset a component of income with a component of expense, you've created a profit. And any form of all of these profits is going to be regarded for the purpose of income tax as taxable profits. Which means we are not looking at taxable profit from the definition in CETA or PPP, but rather we are looking at it from the context of any form of profit that is subjected to tax is what we consider a taxable profit under IAS 12. Any questions so far? Any questions so far? Now, let's now give examples of taxes in Nigeria. Examples of taxes borne by companies in Nigeria, which means we limit it to companies. We don't want to do with individuals, because individuals don't prepare account. And what we are interested in is, how do we account for corporate taxes, which may include transaction taxes and income taxes. Now, can you have option of sending a chat or on mute if your background is less noisy, please? Okay, I'll start. I'll start with the simple ones that I've even mentioned. I'll say company income tax, otherwise known as CIT, sorry. Yeah. I also know petroleum profit tax, PPT, which will now be replaced with hydrocarbon tax, 80. Okay. I quickly know of capital gain tax. I've mentioned all those ones. CGT. And I think I've mentioned information technology development was levy. Okay, now I expect you to call one by one. What other taxes you know? You can send the chat or you can unmute. Let's make it engaging.
Education tax.
Tertiary education tax.
I think a police trust fund too.
Okay, we have Nigerian Police Force Trust Fund levy. Okay. I'll help you out the new ones. Nasene levy. Okay, which other ones do you have?
NDDC levy.
NDDC levy. And that is, I think, 10% of your operational cost or your total cost, budgeted cost. Okay, NDDC levy. Which other one?
So this number 7, can you explain it to me?
Okay. Naseni is much more on what's it called? Science, research and science. Okay, this levy was introduced and supposed to take effect, I think, from 2021 year of assessment. Okay, and although all of these things have been contested, okay, by the, what's it called? It's contested by various, how will I call it? What do you call these people? Opinion, what's it called? CSOs, lawyers, companies, and some other things. And like, same thing, like the court ruling has even ruled against MPF levy that says that it's unconstitutional for such levy to be made because the Constitution has already provided for how the Nigerian police force should be funded. Okay, the NASENI more or less is talking about your contribution by way of levy to the National Agency for Science and Engineering Infrastructure. Okay.
Okay, thank you, sir.
Yeah, NDDC levy is only for upstream oil and gas because they operate within the Niger Delta Development Area, and therefore the levy is such that I think 3% of their budgeted cost for a year have to be contributed to that fund, which will be used to develop the Niger Delta area. Okay. And this levy, even though PIA has been introduced, does not necessarily drop that levy, which means the levy is still going to stay in addition to other consideration I think PIA provides. Okay, which other one? I think I can quickly put one, value added tax. But we are still going to more than 20. Please, guys, don't relent. What again?
Companies also bear custom duties.
Custom duties. Custom duties, that is on importation. Custom duties will also go for import duties. Okay. And there's excise duty. Excise duty is for local production. Now it has also been extended to imported items of which has a local substitute that pays excise duties also. Okay, what again?
Stamp duties, sir.
Stamp duty. Okay. What again can we think out of the box? Withholding tax. We'll come back to that. Royalties. What else?
Commission tax.
Excess dividend tax. Minimum tax. Yes, I'm waiting for you. Business levies. Business levy. State development levy. I'm
Land
waiting.
rent, sir.
That is land use charge,
Yes, sir.
which some people know naturally as tenement rates. Okay, what else? Any other one? I'm waiting. There are other taxes.
Commission tax. Tax is paid on commission.
What does that mean?
For a company that does probably a transaction that require commission to be paid. Okay, still fall under withholding tax.
Okay. Let's look at consumption taxes of some states, whether legal or not legal. They are still collecting it for now. What other one? There are other ones.
The local government collect acting permits.
Revenue tax. These ones I can group them together.
Okay, sir.
Let me just say, let me just call it ancillary taxes. Then put in front local government, all those radio, television, and also of taxes. Okay, those ones are revenue tax are like the one MTN and the like space to NCC and some other ones that are operating under regulatory requirement to do so. There are other taxes we've not talked about.
There's a next fee for the oil and gas on exports.
Now you talk of NCD levy that is paid based on local content, paid to the NCDMB, which is the Nigerian Content Board, local content. Okay, which other one?
NIMASA.
NIMASA, what do you pay to NIMASA as a tax? Remember, this is not what you pay as a result of services rendered. We are talking of what you pay compulsorily without necessarily getting any service or any value for. You are only paying compulsorily based on what you do or what you earn. Sir, you are making something. You make mention of something I didn't capture before I talk about.
I said next fee, sir. Next fee on exports.
Next fee. Can you?
NESS. I think the full meaning is Nigeria Export something scheme.
You said NE?
NESS. NESS. N for Nigeria, E for echo, S for sugar, another S for sugar. Yes, sir.
Okay.
Next fee or next levy.
Okay. And I think there's also one for oil and gas upstream, NIPEX. Okay. Now, there are a lot of all of these taxes. Okay, remember, if you are paying government to do something for you, that is not tax. That one is contractual. But this we are talking about is that once you are caught in a web of doing something into production, into this, into that, you compulsorily must pay it. Therefore, in that case, you pay it. And I think I can remember cabotage levy. And that is much more for those into shipping. Any other one? Shipping and services cabotage, there's no R there. Okay, now we've tried to mention this. Now, the next order we have is to separate these taxes here, since we have knowledge of them, into, if the reference or basis of determining that tax is capital, therefore we treat it as transaction tax. If the basis is revenue, we treat it as transaction tax. If the basis is production or output, we treat it as transaction tax. If the basis is consumption, we treat it as transaction tax. If it's head count, we treat it as transaction tax. If it's asset-based, we treat it as transaction tax. If it's cost-based, we treat it as transaction tax. But if it is profit-based, we treat it as what? Income tax. Now let's now pick it one by one. What can you say about company income tax? Is it transaction tax or income tax?
Income.
Why is it income? Because it's based on profits. Abi?
Yes, sir.
Remember, we'll define what profit is, regardless of the aggregate level of profit, which means this is income tax, IT. Petroleum profit tax or hydrocarbon tax, they are both income tax. Capital gain tax. Before you have a capital, you compare the proceeds of disposal of an asset, which is an income. You compare it with the cost of that asset, which is an expense, which means you only pay it when there's a gain, and therefore is an income tax. Information technology development levy, you pay 1% on your accounting profits, which is on your net profits, and that is also an income tax. Tertiary education tax, you pay it on 2.5% on your assessable profits. Therefore, that is also income tax. Nigerian Police Force Trust Fund Levy, you pay it on your profits, is also an income tax. NASENI, you pay it on profit, is also an income tax. NDDC levy, you pay it on cost, budgeted cost of oil and gas company upstream. This is a transaction tax. Value-added tax, you pay it on the value of consumption, is a transaction tax. Custom duty, you pay it on the value of imports, is a transaction tax. SIDT, you pay it on value of production locally, and also imports for those that have local substitute, of which they pay SIDT, transaction tax. Stamp duty is based on either flat rate or ad valorem on the value of document to be stamped, transaction tax. Withholding tax, I'll come here and put question mark. Probably will come later to discuss that. I'll put question mark. Royalty is based on production or output, sold or produced. Therefore, that is transaction tax. Excess dividend tax, I'll come back there. I'll put question mark. Minimum tax, I'll put question mark. Business premises levy, that's transaction tax. You paid for every location you have. State development levy, you pay it 100 naira per every stamp you have. Land use charge, settlement rate you pay based on the value of the property, transaction tax. Consumption tax, transaction tax. Revenue tax, transaction tax. All of these local government auxiliary taxes, transaction tax. NCD levy is on the value of what is supplied to an upstream entity, which is to compensate for local content, transaction tax. Next levy and NIPEX, transaction tax. Cabotage levy, transaction tax. Therefore, you've been able to delineate what are income taxes away from transaction tax, except for withholding taxes, excess dividend tax, and minimum tax. Now, can somebody guide me why these three they have question mark? What is their peculiarities and how do we address them before we forge ahead? We can't start to discuss on income tax except we are able to resolve all of these issues so that we know what an income tax entails away from transaction taxes. Okay, who will contribute? Anyone, sir?
I will take the withholding taxes.
Okay.
Though it has a resemblance of a consumption tax, because it's being charged when a service is rendered or goods are supplied. However, withholding taxes are not taxes, on their own. Rather, they are deposits against income tax, which will fall due at the end of the accounting year. So, for instance, when a company, renders a service and issues an invoice and is paid less the withholding tax, the company hasn't technically suffered that tax, but rather the company has made an advance payment to the revenue, to the tax authority, which that company can use to reduce its tax obligation at the end of the year.
Okay. Now, is there an instance in which withholding tax can be considered a final tax and thereby we consider it as an income tax? Is it possible? In what situation can it be?
Yes, I think it's a yes for some transactions. Withholding taxes are deemed as the final tax. I think transactions like dividend, withholding tax paid on dividend or certain dividend are deemed as final tax, and for some companies, by the virtue of the the nascent finance acts, for some companies, the ones we call the non-resident companies, for some of them, withholding taxes charged are deemed as the final tax.
Okay. Now, thank you very much, sir. Any other person before I make commentary? Before I make commentary, any other person? Okay. Now, when I talk about withholding taxes, naturally, withholding tax is not even a tax. Therefore, in its real context, we shouldn't be even talking or trying to say it's either transaction or income tax. Because naturally, it's just a deposit you are making in anticipation of whatever tax will be in the future, which means you pay withholding tax, or withholding tax is deducted from your revenue or income on the premise that you will have income tax to pay to government. Therefore, withholding tax should then be treated as an advance payment of tax, or not just an advance payment of tax, an advance payment of income tax, because it can only be used to reduce your income tax. No other tax can it be used for. Now, withholding tax in that case then means it's not a tax, but a treatment of an advance deposit, which means government is owing you, simple. But there are instances where withholding tax can be considered a tax. And not only that, it's considered a final tax, which is a final income tax. And this is applicable to the following instances. One, every equity investment a company makes, which means you invest in other company's shares, whether preference shares or ordinary shares or whatever shares is it, and you earn a return, let's say 100 naira. A withholding tax of 10% will be withheld, which is 10 naira. And that 10 naira, instead of treating it as an advance payment of tax, it will rather be treated invariably as income tax. Why? Because the 10 naira you pay on the 100 naira dividend is deemed to be final tax you pay on that dividend, regardless of whatever cost you incur in paying it. Which that means that when you are now to assess yourself to tax at a later date, the dividend income will be excluded in arriving at your taxable profit, all because that has already been subjected to tax separately. Which I mean invariably, your income tax aggregate will be the 10 naira you pay on withholding tax plus whatever your income tax is, excluding the dividend. That's how you arrive at your income tax. Which then implies that withholding tax in some instances can become an income tax, though naturally it's not a tax at all, which means we won't even talk of transaction taxes when it comes to withholding tax. But though it is charged on a transaction, but it is charged on the premise that that transaction will yield profit and therefore be subjected to withholding tax, which is an advance payment of income tax. Which means in this case, there are two ways to which it can be treated. Naturally, not a tax, but a deposit for sole purpose of tax. But in another way, for frank investment income like dividend, it is an income tax. Let me use the red. It is an income tax. Only when, one, it relates to dividend, which is a frank investment income, or two, it relates to foreign interest on loan, technical or management services for foreign transactions, which means if a foreign company give loan to a Nigerian company, the withholding tax held on that interest is considered to be final. Therefore, that is the income tax with respect to that interest to a foreign company. Or a foreign company earns technical management consultancy fees in Nigeria. The withholding tax will be deemed to be the final tax, which is an income tax on what is presumed to be the profit, given that there's no cost to any such an income. And that is a position with respect to Nigerian tax law. Now, let's talk about excess dividend tax. Have you heard of excess dividend tax before? Have you heard of excess dividend tax before?
Yes, sir.
What is this? Or what is its reference?
Okay, it was the unpopular tax that came out of a decided case against O&O some years back. So as we now know it, it is a tax that becomes payable where a company declares dividend in excess of its profits for that particular year. So the tax authority deems that as dividend paid out of retained earnings. So, and when that happens, excess dividend tax automatically kicks in. The excess of the dividend paid above the profit for the year is taxed. I think I've forgotten how it's taxed now. I mean the rate. So that's essentially what the excess dividend tax is.
Okay, now let's look at it. Excess dividend tax is such that if, for example, you pay 100 million dividend in a year, whereas that 100 million dividend is higher than your taxable profits, or no taxable profit at all. No taxable profit because you've used you have losses or your capital allowance, you lost your leave as already subsume all of your profits, which means you will not have tax to pay in that year. Or your taxable profit in that year is lower, let's say 80 million. In that case, your tax you compute on taxable profit is small. You will now also have to pay tax on additional 20, which then means that tax you pay on this one, let's say 30% CIT, is 24 million. This 24 million is lower than what you have paid on dividend because the dividend you pay in that year is more, which is 30 million. The difference between this is 6 million you are paying on excess dividend, which means how dare do you declare dividend in excess of your taxable profits? Therefore, that excess will be charged at CIT, which is 6 million, which means the difference between 30 and 24 is 6 million, which is the same thing as 30% of 20. Now, this 6 million plus this 24 million is what we consider as excess dividend tax. But invariably, what is excess is just this 6 million. This 24 million, we have no problem about it because this 24 million is outrightly an income tax. But this excess I will not treat it as income tax because it is based on a parameter that is not profit. And therefore, this 6 million, I'll treat that one as transaction taxes, which means it's 24 million that is income tax, 6 is transaction taxes. But FRS is not interested in anything. FRS is interested in 30 million. Whether you call it income, you call it whatever you call it, is your business. What matters to FRS is you are collecting taxes. But for financial reporting purposes, I'll treat 24 as income tax, I'll treat 6 as transaction tax. And that is the issue on excess dividend tax. Any question on that? The next one I'm going to consider is minimum tax. Now, somebody said something about minimum tax. What is minimum tax? What is minimum tax?
Okay, minimum tax are taxes that you pay out of your revenue, less any frank investment income, in case a company is making loss when it has commenced operation for more than 4 years.
Okay. Let's look at it from this perspective. Now, minimum tax is applicable in the following instances. One, where a company has no taxable profits. In that year, you have losses, or all your profit have been wiped out by absorbed losses and or capital allowance. Or you have taxable profits, but where a company's taxable profits is lower than where a company taxable profits, where a company taxes on taxable profits. Let me write it up. Where a company's tax on a taxable profits where a company's tax on taxable profits is lower than the minimum tax. These are the two instances in which minimum tax are applicable. But there are exceptions or exemptions. Where minimum tax will not be applicable. One, for every company in its first 4 years of operation, minimum tax will not be applicable. And minimum tax is also not applicable for companies in agriculture and I think agro-allied. Businesses. Okay. Any other question before I move on minimum tax? Any other question? Any other question? Also, a small company is exempted. And by Finance Act, a small company is a company with turnover of less than 25 million. And they are not even subjected to any form of tax, talk less of what? Minimum tax. Okay. Any other question?
I'm unsure if companies, enjoying pioneer status are exempted from minimum tax. I just need that clarification.
They are not even in tax. I can just add it. They are not, okay. When they are on tax holiday, they don't even pay tax, talk less of minimum.
Oh, all right.
Companies with tax holidays. With tax what? Holidays. That is, they have pioneer status incentives. And likewise, companies with gas utilization incentives. GUI are equally within. For GUI, you can have as much as 3 to 5 years, and likewise for pioneer status, 3 plus additional 2 to make up 5 years extension. Okay, but again, when you check these three, for the period they fall in this, they are not even paying tax at all. No income tax at all. No income tax at all. Take note of that. Which means where there's no income tax at all, there's even no need to talk about minimum tax. Okay, as I said it earlier, these are just the exemptions that exist. Now, what then is the issue? The issue is synonymous to excess dividend tax, which means, for example, let me give an example. If your minimum tax which initially was 0.5% of gross turnover, which was reduced for the first 2-3 years, which you can only claim 2 consecutive periods, 0.25 reduction, which means let's just assume the original rate, which everybody is reverting to from this year, which is 0.5% of gross turnover. Let's say, for simplicity's sake, is 100 million. You compare it with your CIT, which is 30% of taxable profits. Let's say that gives you 85 million. Now, in that case, you'll be paying additional tax of 15. This will be additional tax of 15. Okay, let's say this scenario A. Let me put scenario B. In scenario B, you have 100, but this is taxable profit is 0. Therefore, you are paying 100. That's what it also means. Now, let us look at scenario C. Scenario C, okay, let me make this one A. This scenario A, minimum tax is 100, but your company income tax is 110. In this case, what is additional tax? Nil. Because what you are even going to pay is far more than the minimum. But where what you are going to pay, which is in scenario B, is less than the minimum, you pay additional 15. And where you are not supposed to pay at all because you have loss, you are still going to pay the difference between taxable profit, which is 0 tax, and 100 million, which is additional this. The question then is, if you are to delineate, delineation of taxes in this case, what is income tax and what is transaction tax or other tax? Remember, the total you are picking a maximum is 110. The maximum here is 100. And the maximum here is also 100. Now, if I'm to delineate it, which is A, B, and C, income tax here will be 110, and there's no transaction tax. Income tax here will be 85, and there's transaction tax of 15. Income tax here will be 0, and there's transaction tax of what? 100. Remember, this is a balancing what? Figure. Now the question then is, how do we treat transaction tax? We'll come to that. But let me give you this information, and I want you to tell me what you will do. Practical scenario of a company in business over 10 years. It is a trading company. The following information are made available. One, company income tax initially computed or assessed as 80 million. Two, minimum tax is assessed to be 90 million. Excess dividend tax maximum amount was 105 million. In this case, one, what is the amount of final corporate income tax in which the company is to be assessed? B, based on your answer in A above, kindly delineate where applicable the final corporate income taxes into income tax in line with IAS 12 and transaction tax or taxes. Now, who can give me a guide to this? Who can give me a guide to this? Okay, or let me allow you guys to discuss, and you discuss it for 5 minutes, and I'll get back to you on what is appropriate. Okay, over to you guys. Okay, since you guys have more or less deliberated, can somebody present your conclusion and let's see whether it's in tandem with what I'll be providing. Okay.
Okay, sir. So we agreed that the final corporate income tax will be 90 million, which is the higher of the minimum tax and the initially computed tax. For the B, it was a consensus that if we are to delineate, the taxes into income tax according to IAS 12 and transaction taxes, 80 million will be the income tax, while 25 million will be the transaction taxes.
Okay, which means when you look at it in this manner, you are looking at it that you have CIT, 80 million. You have minimum tax, 90 million. And you have excess dividend tax, 105 million. Now, what is the maximum? The maximum is 105. And that 105 can be delineated into two. Income tax of 80 million, which is this, and transaction tax of 25 million, being the difference, balancing what? Figure. Okay. And the question next is, how do we treat transaction taxes in this case? How do you treat transaction taxes? Now, how are transaction taxes treated? Now, transaction taxes are treated in line with relevant IFRSs and best accounting practices, and I will explain. For example, transaction taxes that relate to PPE will be treated in line with IAS 16. And when we get to IAS 16, you'll see what we're talking about, which is to capitalize non-refundable. You capitalize as cost of PPE, non-refundable taxes. Similarly, transaction taxes that relate to inventory under IAS 2, you also added onto the cost of inventory, the non-refundable taxes. TT relating to others are equally treated in similar manner to elements of financial position. With respect to assets and liabilities. Now, transaction taxes that relate to equity is treated as a deduction from equity, usually through share premium or retain what? Earnings, as the case may be. Now, other transaction taxes are expensed. Usually, those relating to revenue or income on a standalone basis, and those relating to expense items. That is, every other one are expense. Let me put it in capital. Every other one are expensed. Which means, in this case, this 25 will be a component of operating expenses. That is with the admin management fee. And this one will stand in as our income tax, which is charged to our profit before tax. Which means we have been able to successfully now explain the difference between income tax from other forms of taxes, which we collectively consider as transaction taxes. Okay? And this is how we report them. And where they are commingled, we need to delineate them, regardless of whatever we pay to the tax authority. And I think there's something also okay, let me copy this. Okay. Now, let me allow you to read this out so that you also know exemption that exists for companies with excess dividend based on the Finance Act of 2019. Okay, so that you know that there are also exemptions to dividend tax. Can somebody read? Mr. Denny, can you read for us?
Exemptions to excess dividend tax under Finance Act 2019. Favoring the clamors for the review of this harsh provision, the National Assembly passed the Finance Act, which created exemptions to excess dividend tax in Nigeria. Section 7, subsection A of the Finance Act amended Section 19 of CETA by providing for instances where the dividend of a company will not be subjected to income tax, where the company does not declare profit for the year or where the profit of the company is less than the dividend declared. The exceptions are listed below. Dividends paid out of the retained earnings of the company. Where the dividends of a company is paid out of its retained earnings, which have been previously subjected to company's income tax, capital gains tax, or petroleum profit tax, the company will not be required to pay CIT on it. 2, dividend paid out of profits exempted from income tax. Where a company pays dividends from its profit which has been exempted from tax by any law in Nigeria, the dividend paid will not be subjected to excess dividend tax. 3, franked investment income of the company. CETA defines franked investment income as a dividend received by a corporate shareholder after deduction of withholding tax. The implication of this is that companies, e.g., holding companies, are no longer required to pay excess dividend tax on declared dividend, which originates from franked investment income. 4. Distributions made by a real estate investment company to its shareholders. Where a real estate investment company distributes dividends to its shareholders from its profit made from rental income or dividend income, such dividend declared will be exempt from excess dividend tax. This based on the provision of the Finance Act, which exempts the rental and dividend income of real estate investment companies from tax, provided that 75% of the dividend and rental income is distributed within 12 months after the end of the financial year in which it was earned.
Okay. Thank you very much, sir. Thank you very much, sir. Therefore,
please, I have a question.
Yeah, what's your question, sir?
Okay, so I'm looking at these exemptions, which I mean, it looks like they've covered almost everything, which used to give rise to the excess dividend tax. I'm now wondering, aside these 4 scenarios, I mean 4 areas which the exceptions have covered, where are the other areas which the excess dividend tax can still apply today?
Okay, I don't think they've covered everything, but again, as you have said, most of all of this may have necessitated a situation where there might be excess dividend tax. But there are other situations. You know, sometimes the dividend policy of a company, especially for quoted companies, might also force that company to declare dividend more than what is its taxable profit is. For example, a company that is already known that the minimum they will pay as dividend is ₦1 per share. But unfortunately, let's say during the COVID, the operation of the company was scaled down because of COVID, and they are unable to make sufficient profit that can pay that amount of dividend. But because they have a policy over time that the minimum amount they pay is so much, they'll be forced to go into their retained earnings to pay, or they'll be forced to even borrow to pay. Do you get what I'm saying now? But the issue there is that since even retained earnings that has been previously subjected to income tax is exempted, probably there won't be a situation where such excess dividend may arise. Do you get what I'm saying now? But the reality of it is this: whatever the situation it is, which you cannot preempt in the future or in the immediate, once you back out all of this, therefore, and there's no amount of excess dividend, so be it, there will be dividend tax. But 1 or 2 things can equally create such a revenue. But again, in principle, it seems excess dividend tax is going off the radar as it is today. But again, this has much more been replaced by enhancing the value of minimum tax, where minimum tax now is based on gross turnover. And gross turnover is defined as your revenue plus other income that are not exempted from taxes. And where the challenge is that what of other income, such as unrealized income? Unrealized income might be as a result of exchange gains, okay? Because most times FRS want to treat exchange gains, whether realized or unrealized, as other income. 2, even if all the exchange gains are realized and you consider it as other income, what happened in the year you have exchange loss? It's not always taken, because what they consider as gross turnover is only the income side, which means all of those lacuna is still being created. That means on one hand, whenever I have exchange difference that is a gain, you tax me. When I have loss, I don't get relief, I don't get anything. And therefore, is that not a double jeopardy? But again, we are not speaking to tax. We are only speaking to accounting for taxation. and of which our much more aspect to which we are considering is income tax. Does that make sense, sir?
Yes, thank you, sir.
Okay. Now let's move further to situation where we are going to more or less recap our understanding of income tax. Now, as I've said earlier, income tax, we can break it down into two: current tax and deferred tax. And again, what is current tax? Current tax are the actual tax payable based on current year performance, and deferred tax are more or less taxes relating to current transactions or events, but of which the tax consequence are to materialize at a future date. But we're going to look at it critically as we move on. Now, let us try and recap how current tax are computed. Okay, the essence is that you can't be able to account for what you don't have good understanding of. And that's why I'm going to make this practical demonstration of what current tax can be. How do you compute our corporate taxes, corporate income taxes? Okay, I'm creating this template for us now. Remember that we first of all start from accounting profits. And accounting profits are otherwise known as profits before taxes. A profit before what? Taxes. Now let's say our accounting profits or figure in thousands. Okay. Now, you carry out tax adjustments, and these adjustments, I can put them under 4 headings, and I'll explain them one by one. First item are non-allowable expenses. Second item are non-taxable income. Third item are omitted allowable expenses. And fourth item are considered omitted taxable income, and I will explain. Now, when we talk about non-allowable expenses, another thing you can call them is non-taxable expenses, not deductible expenses, rather. Now, non-allowable expenses or disallowed expenses or non-deductible expenses are expenses of a nature that, one, they are expenses that may have failed what I would call rent test. What is a rent test? That is expenses that from the tax law or perspective of the tax law, they are expenses that are not only reasonably, exclusively, and necessarily incurred in carrying on or conducting the business of the entity. Such expenses will not be allowed. Example is frivolous donations, promotions, and some other expenses that may have no bearing in the conduct of the business of the entity. But we also have some category of expenses that are valid, but of which they are not allowed for deduction on the premise of how they are arrived at, but rather there is a surrogate at which they are subjected to deductions. To simplify it, depreciation is a valid expense for tax purposes, but the tax law does not allow accounting depreciation for reasons best known to the law. One, accounting depreciation is a reflection of various entities' usage or pattern of usage or pattern of consumption of the assets, which might vary from company A to company B. And the tax authority may not have the mechanism of tracking such utilization from one company to another. Rather, the tax authority will prefer to use a standard basis that is applicable across all entities, which is much more easier to track and administer. Also, tax authorities are not much more disposed to series of methodologies, method of depreciation. Therefore, they standardize their own method so that you only charge tax depreciation by way of initial and annual allowance where applicable. And thirdly, accounting depreciation might have undercharged the profits accessible to tax on the basis that you are only charging depreciation on the actual cost, whereas tax depreciation also comes with some benefit outside the actual cost. For example, when you incur a capital expenditure, qualifying capital expenditure on plants and machinery, you are entitled to investment allowance, which is an addition of about 10% on the cost, which is not deductible against the cost, and therefore of which accounting depreciation does not capture. Which I mean, in this case, we are disallowing accounting depreciation, amortization, and the likes, and you'll be replacing them with another deduction below the line, which is otherwise known as capital allowance. And capital allowance is the legal nomenclature given to what we call a tax depreciation, which is a surrogate to accounting depreciation. And lastly, you also have issue that borders on loss on disposal of asset, which is not taken into consideration. Rather, you might be entitled to balancing allowance as a surrogate for any loss on disposal of assets as validly measured or assessed from the angle of the tax authority or from the tax law. Which that means that any category of expenses that falls under any of these three, we will consider non-allowable expenses, non-deductible expenses, disallowable expenses in this context. And therefore, what do you do? All of these expenses have been charged in arriving at these profits. Since they are no longer allowable due to those reasons as aforementioned, therefore, I have to reverse all of this charge by adding it back. Which that means that invariably, all of these, I have to add them back. Now I'm using hypothetical numbers. And if I add them back, let me use these hypothetical numbers. What then do? I add them back so that if I add them back to this 100, I'll be having 114. I'll be having 114. 114, which you can see here, 800. Okay. Now, next, I have non-taxable income. What are non-taxable income? Non-taxable income are more or less income that are included in these profits, but of which, for one reason or the other, Either they are not taxable at all because they are totally exempted, or they have been taxed already in the prior period on a cash basis, of which accounting-wise we are recognizing them today on accrual basis, and therefore affliction should not rise the second time, which means no income should be subjected to tax 2 times. Or they have not been subjected in prior period, but they are subjected in the future period, or because they have not yet been received, and income of such a nature are subjected to tax on cash basis, whereas in accounting manner, they are already accrued as income based on accrual concept in the current period. All of this could give rise to non-taxable income, or some income that are totally exempted from tax, or some income of which they are subjected to tax under a separate tax regime rather than under company income tax. And these items, I can delineate them one by one as follows. The first one are income totally exempted from tax. Income totally exempted from tax are example. If you have certain income, like if you have treasury bills or government bond, prior to now, since 2011 up to 2021, you have income on government short-term security exempted from tax totally. Okay, but going forward, they are no longer exempted. But we still have government bond. Coupon from government bond are still exempted from tax. Therefore, such income will not be subjected to tax, and they are already included in this 100 million. Therefore, you deduct them. Also, we have income that you have earned but not yet received in cash. But once you receive them in cash at a later date, probably next year, that is when they will be subjected to tax. Whereas accounting-wise, income has been recognized when it was earned rather than when it was received. And in that situation, such an income will be more or less deducted from this profit, or because it will be subjected to tax at a future date on a cash basis, or it has been subjected to tax in the prior period on a cash basis. Now we also have income that will have fall under tax under a separate tax regime. Example of them is capital gain tax. Rather than subject profit on disposal of asset to tax under CIT, such will be subjected to tax based on the requirement of the Capital Gain Tax Act, where the chargeable gain being the excess of the sales proceeds on disposal of assets over the cost of that asset as at the point of disposal will be subjected to capital gain tax at 10%, which that means that every profit on disposal of assets in this manner will be exempted from the CIT computation. And lastly, as I have said earlier, we might have some income that has been subjected to one form of tax or the other before now, and of which that tax to which they are subjected to is considered final and conclusive. And this reminds us of our discussion earlier on withholding tax, which is considered as a final tax on dividend, which in this case, the dividend is considered a frank investment income. In that manner, when we have all of this, we are going to more or less consider them, aggregate them, and deduct them from this profit because they have overstated this profit that will now be assessed to tax, which means all of these amounts, which are hypothetical figures, will be deducted from this 100 million. Now, we also have omitted allowable expenses. When I say omitted allowable expenses, what do we mean? It's not that the expenses are omitted in your financial statement, no. But rather, for tax purposes, they ought to have been deducted before now in arriving at your taxable profit, of which they are not yet deducted from this accounting profit. Example of them is this. You find yourself in a situation where, from accounting perspective, certain items of cost do not qualify as an expense. Rather, they qualify as an asset, which have to be amortized over the useful life. Example is development costs. You know, when you have research costs and development costs in line with IAS 38, you find out that research costs are always expense, and development costs, after passing certain criteria, are capitalized and amortized over the period that has been estimated, probably also 5 years. Which that means that certain portion of development costs are suspended as an asset rather than as an expense for tax purposes. In that situation, the tax position will see mean that all of your development costs ought to have been expensed, and the portion that is not expensed is considered omitted for tax purposes. Therefore, since it is omitted and we have identified that, therefore come and deduct them. Similarly, when you get to oil and gas accounting, where certain aspect of the intangible cost is expected to be expensed rather than capitalized for tax purposes, but for accounting purposes, they are capitalized. Therefore, such item will be deemed to have been what? Omitted, and they are deductible against taxable profits. And that is why we are doing what we are doing now. And lastly, there, we also have accrued expenses. Now, some expenses are not allowed to be deducted on an accrual basis, okay? Tax law may warrant that certain expenses are to be deducted only when it has been paid for, so that you would have gotten a tax deduction on what eventually would not be paid for. And in that case, accrued expenses which impact your financial statement based on the principle of recognizing an expense when it is incurred rather than when it is paid for, will now violate the position here, whereby last year I've incurred the expense and I recorded it for accounting purposes, but it was disallowed. But this year it was allowed, even though it is not in my expense in the financial statement. Why? Because it is not allowed, because it has actually been paid for. In that manner, therefore, what happens? At the end of the day, such expenses that were considered omitted and not yet deducted will now be deducted, hypothetically, in this case. Finally, I have omitted taxable income. In this case, I'll consider a situation whereby income earned in prior year, but of which cash is received in the current year, is deducted against, is more or less taxable in the current year. What does that mean? It means that, imagine you collected rent for 2 years, and the tax law says rent received is subjected to the tax in the year the rent was received. Which means if the tax law recognizes cash basis for subjecting rent to tax as an income, that means that if you have collected rent for 2 years in the first year, accounting-wise, you are going to recognize only 1 year rent as income, and you defer the second year rent as deferred income. But the tax law is saying, no, all rent received is subject to the tax in the year it was received, not necessarily the year to which the benefit arose. Therefore, in that situation, it then means that for tax purposes, they will consider that you have not recognized all your income that is subjected to tax. Therefore, the one you have suspended as deferred income should be accelerated for recognition in the current period, thereby subjecting the rent of 2 years to tax in the first year. Okay, again, it depends on the tax law of the jurisdiction in which you operate. But in this case, we assume that the tax law subjects any form of such an income to tax on a cash what basis. And in that situation, we have a rent of 1.58 million that we have collected in advance, to which we are now being subjected to tax in the current period. At the end of the day, what do we have? By the time we pass all of these 4 categories of adjustments, these are added back, these are added back, and these are deducted. All of these will give me what I will call my profit adjusted for tax what purposes. Now, this profit adjusted for tax purposes is what I can otherwise know as my assessable profit, or what some people will call adjusted profit. Now, the definition of adjusted profit under SITA is different from the definition of adjusted assessable profit. The definition of assessable profit under SITA is different from the definition of assessable profit under PPT. Even though under SITA, assessable and adjustable profit are the same, but under PPT, they may not be the same. Okay, but we are not discussing tax here on its technicality. Okay, now, apart from that, losses of prior periods, you may enjoy it in the current period. What does that mean? Imagine last year we made loss. By the requirement of the tax law, losses of last year, you can carry it over to the current period so that you can absorb all of the losses in that year. What it simply means is that loss of last year was 18 million. I can absorb all of the 18 million in the current period, which means if I absorb all of the 18 million in the current period, what have I done? I've simply more or less from this definition to more or less use it to reduce my tax for the current period. And what it means is that I can only absorb all of these losses provided my assessable profit is sufficient enough. And when you look at this, what I relieve is the minimum of what I have here as a loss and what I have here, which means if my loss is more than 101,880, I can only relieve 101,880. But if it's less than 101,880, I can relieve all of the losses. In this case, it is less, which means I can comfortably deduct all of this loss against this profit, so that what is left is this amount. What is left is the sum of 101,880 minus the loss I've relieved. Now, what it means is that let us change it that the loss we have is 120 million. It shows that I cannot absorb all of the losses because the profit here is just 101, and the whole loss I'm bringing forward is 120, which means I can only get 101 maximum relief, and this other one I have to carry it forward, which means the worst situation I can have is 0 after relieving the loss. It can be negative, okay? But if it is less than, it can always be negative. For example, let me just put it at 20, which means I can absorb all of the 20. Does that make sense to us? Okay. Yes. But again, there are rules for how long we can carry loss. For companies in manufacturing, for companies in agriculture business, and for companies in agro-allied, you can carry your losses as far as possible, okay? But and also for company manufacturing, yeah. But for other companies, you may not be able to carry your loss beyond 4 years, which means loss of year 1 cannot be carried forward beyond year 4. Okay, that is beyond year 5, yeah. Which means year 2 will be the first year, year 2 will be the first, year 3 will be the second, year 4 will be the third, year 5 will be the fourth. Okay, now, if you also have loss in year 2, it is not cumulative. You have to treat each loss separately for each year. And each of them cannot be carried forward for more than 4 years. And you must more or less relieve the earlier losses before the later losses. Those are the methodologies involved. Okay. Any question? You are trying to ask a question.
Yeah, my question is, based on the current happenings now on this tax format filing, when you file, definitely the tax will be completed. I don't know if for this issue of carrying losses forward, can that be applicable?
It is applicable. That's why the first time everyone adopted tax formats, you are told to reconcile with the tax office so that they can impute all your previous years. That's the most recent period, which was 2020 then, into the system so that you can carry forward, and going forward, things will normalize. It's only if you have not done that, or you guys are having disagreements, especially with respect to audit, that may not have given rise to what's supposed to be. Okay, that is that. But again, we are not going to speak to tax. We are not discussing tax as in taxation. We are discussing accounting for income taxes. Okay, now the next aspect is capital allowance. Again, remember, we talked about substituting capital allowance for depreciation here. Okay, therefore, when we have capital allowance, before you even talk of absorbing your capital allowance for the current year, you must first of all consider the balance brought forward, which means any capital allowance you did not utilize last year will be brought forward to this year. In this case, we assume that we have, let me say, 10,000 capital allowance or 10 million capital allowance last year that was not utilized. And we are now going to consider what is our capital allowance for the current year. Okay, let me say for the current year, our capital allowance, let me say it's just 35,000. Let me say it's 35,000. Therefore, what I have is 45,000. Now, of this 45,000, how much can I absorb and how much can I carry forward? What I can absorb will also be subject to the profit available. Otherwise, I cannot absorb more than what it is. Now, the profit available, as you can see here, is this. This is the profit available, yeah? First, the provision of the law says that except for manufacturing, except for agricultural businesses, and except for agro-allied, every other company, and except for oil and gas companies that have their own restrictions separately, that is upstream oil and gas, E&P, your restriction towards absorbing capital allowance is 66 2/3 of your assessable profits. But again, it is subject to availability of profits after deducting loss what relief, and I'll come to that. 66 2/3 is the same thing as 2/3. They are going to give you the same results, but let me put this and let me make it superscript. Okay, 66 2/3 is the same thing as 2/3 of assessable profit, which means what is 2/3 of assessable profit? 2/3 of this profit is this, which means when you look at this amount is the maximum capital allowance you can enjoy. But if you have lower than it, you can enjoy it all, which means 45 is lower than this if I can absorb all of this 45. Okay, now where the problem lies is that this 45 is lower than this. But what if my loss relief here is 80 and what I have here is 21? Therefore, there's no way I can deduct 45 from 21 and it will not turn to negative, which means whatever I can enjoy here will still be subject to the maximum of whatever I'm deducting here, which is this minimum, and what is here. And from that, what I'm trying to do is that, sorry, as a maximum, minimum. What it means is that anytime what I have here is lower than whatever the restriction is, I can't go by the restriction. I have to go by the lower amount, which means if I go back to my 20 here, You see that he allowed me to take the whole of 45 because it's lower than this. But if the 45 is lower than this, but what is here is lower because, one, I have 90 here. It means there's no way I can take 45 out of 11,880, even though 45 is less than 67,920. Therefore, I'll be restricted to this, which means I'll still be restricted to availability of profit here. And that's what it means. Also, what if the loss here is more, like 120? You find out that there's no profit here, which means there's nothing to even absorb at all. I'll still be carrying that 45, even when the 45 is lower than the restriction. Are you getting the logic? And that's what I've done there, which means I turn this to 20, and in that case, I can still enjoy the entire 45. Because one, it is lower than the restriction, which is 6 2/3 of this assessable profit, and two, it is still lower than the available profit after the loss relief. That is that. Take note of that. Let me just put this here. All of those ones I've already modeled it, which means this 45 will be deducted from this to arrive at what we call our total profit, or what we also call taxable profits. What's our taxable profits? Our taxable profits is this, which means the difference between 81,880, which is our profit after absorbing our losses, and our absorbed capital allowance. And that is that. Any question on this? Okay, now what is our estimated taxes? Now, we can now look at our estimated taxes as follows. We start with company income tax. What's our company income tax? Our company income tax is 30% of 36,880. 36,880 million. And what is 36,880 million? You can come here. The product of 30%. Let me just write the 30% here. Let me just put percentage here. Okay, I'll put 30% here. Now it is a product of 30% and my taxable profit, which is this. And this is my company income tax. What other tax will I compute?
Minimum.
Minimum tax. No, forget minimum tax are extraordinary taxes. We are looking at normal tax itself, normal company income tax.
Okay, maybe withholding tax. Maybe we can just check if there's any withholding tax.
Any
credit
what?
note. Whether there is a credit note to offset or to reduce the tax or so.
No. We are computing tax first. We are not talking of deduction. You must understand your tax first. Now we want to do tertiary education tax, which is 2.5%, Abi?
Yes,
Okay. Police levy, police tax levy or something.
That's 2.5% of accessible profit, which is what? 101,880, Abi?
Yes, sir.
Is that correct?
Yes, sir.
Okay. Therefore, I'll come here 2.5% of my what? Accessible what? Profit, which is 101,880. I'll come here products of 2.5% and 101,880. Does that make sense? What other one? Let me say I have information technology development. And that is 1% of accounting profit. And what's the accounting profit? Profit before tax, 100 million. That's 1%. And that is applicable only to financial institutions, companies into telecommunication and IT. Now, we assume that this company falls within that bracket. It is 1% of accounting profit or profit before tax. We also have NASENI. Remember, NASENI levy. Okay. And NASENI levy is 0.25, I mean. .25% of what? Of accounting profits, which is profit before tax. That's 0.25% of 100 million. Yeah, I want you to give me the other two, 0.25. That is
police trust levy. That's 0.005% also.
There's no also. Tell me what it is. I say also. Oh, yeah.
Police trust levy 0.05%. 0.
Be careful. Is it 0.005 or 0.0005?
No, 0.005%.
Of what? Now, police, Nigerian police, what's it called? Though it's in contention, but let us assume that it is not. It's not in contention. Nigeria Police Force Trust Fund Levy, which is 0.005 of accounting profits. Okay.
Yes.
Therefore, that's what products of this multiplied by our accounting profits, all things being what? Equal. Now, let me add one more. Let me say we have chargeable gain. You know, we have disallowed profit on disposal of assets. Yeah? Where is it? Where is it here? Yeah, we have disallowed this, but by the time we compute our chargeable gain, probably we have 4 million chargeable gain, which is outside the context of this. And I think, let me assume that our chargeable gain was computed independently, and we arrive at that in this manner. Let me say we have another schedule somewhere here. We have another schedule somewhere here where I computed that. Therefore, let's assume that we sold the asset for 20 million, purchased it for 15 million, other liable incidental cost was 1 million, which means we have a total allowable cost of 16 million, which gives us a chargeable gain of 4 million. That 4 million is what we have now come here to subject to tax. At what percentage? 10%. 10% times that 4 million. Where's the 4 million coming from? Yeah, that's 400,000 naira. Now this sum up to how much? This is our estimated corporate tax. Who can tell me why I use the word estimated? Why did we use the word estimated? We use the word estimated instead of actual.
Okay, you know we've not computed minimum tax, so know which one is the higher of.
But let us even assume that this company is not into minimum tax because it's in the first 4 years. Why is it estimated? It's estimated because you don't know your final tax position until you are audited. Audit might still vary some of what we have done, rightly or wrongly, to which we now come to a conclusion of whatever it is, which means it is estimated until you get clearance by way of tax audits. Does that make sense to you?
Okay, sir.
Does that make sense? Do we agree? From our practical experience.
Yes,
Okay.
sir.
Now, this is how we do our current taxes. All things being what? Equal. Do you get what I'm saying now? This is how we do our current taxes, all things being equal. Now, we cannot go back to our presentation slide if there's no other question.
So I have a question, sir.
Now, what's your question?
Okay, sir. The schedule that you did by the side to know the gain on disposal.
Yes.
I noticed you use purchase price. I'm wondering, should I be purchase price or the net book value?
No, you don't compute let me go back. You don't compute chargeable gain on net book value. Net book value plays no role in capital gain tax. Capital gain or chargeable gain is the essence of sales proceeds over the cost of an asset, not over the kind amount or over the net book value. No.
Thank you, sir.
Yes. Okay. Okay, let's go back to our slide. Now, there's what we know as uncertain tax position. Okay, that's what we know as what? Uncertain tax what? Position. And we're going to look at it here. Okay, now let's go back to our discussion. As I said earlier, current tax is ordinarily straightforward. Complexity arises, however, when we consider future tax consequence of what is going on in the account, which is the aspect of deferred tax. We are not looking at that now. But in our books, how do we report in our financial statements? Income tax. Income tax is always the aggregate of current tax and deferred tax. For example, in 2019, our current tax is 845,000 naira. But our deferred tax, either a charge or credit. A charge means an addition to our expense for current tax. A credit means a reduction to our expense on current tax. In 2019, we had deferred tax expense, current tax expense that sum up to 950. Whereas in 2020, we had current tax expense of 1083 and deferred tax credits or income, which is a reduction of our expense by 103. That's why it's minus 103. By the time you deduct 103 from 1083, what is left is 980, which depicts the income tax you will report in your financial statement. Now, when you now want to show what is payable is now based on what you have estimated less what you have paid. And remember that tax is paid on on a preceding year basis. What it simply means is that tax of this year is paid next year. And that's why you find out that usually, except in extreme situation, you have balance of last year tax carry forward to this year. And to determine what is my balance in my balance sheet for my tax payable to FRS, it will be the balance last year brought forward, add the current year tax charge, which is 845, less whatever I've paid. All things being equal, I assume I've paid the actual amount of last year, which was 610 this year, which means invariably I'm carrying forward the tax of this year to next year. And the tax I carry forward in 2019 is what I'll bring forward in 2020. In similar vein with the way I've carried 610 forward from 2018. My current tax charge for 2020 is 1083. And what I paid this year, ultimately equal, is what I was owing last year, which is payable this year on a preceding year basis. Okay, that is that. Okay, you can also see position where my deferred tax liability will be whatever my balance is last year, plus or minus this year. This year I had additional charge, which increases my liability from 325 to 430, which I'll carry forward to 2020. In 2020, I had a deferred tax credit, which is a reduction in my liability of 103, which reduces 430 to 327, which means these two items, current tax payable is a balance sheet item, which is a current item, current liability item. Deferred tax liability, it's also a balance sheet item, but this is a non-current liability item, not current. This is a non-current tax liability item. Okay, and also deferred tax can be an asset, which I'm going to look at. If it's an asset, it's also going to be a non-current asset item. Likewise, in extreme situation, current tax might be an asset rather than payable, which means if you have current tax assets, it is a component of current asset and not a component of non-current asset. In similar vein, if you have current tax payable, is a component of current liability and not a component of non-current liability. And at every point in time, you must distinguish your deferred tax from your current tax. Okay, even though in the income statement item you just show income tax, in your notes, you must still be able to delineate, to attribute the income tax to the component of current tax and to the component of what? Deferred tax. Okay, we might check one or two financial statements where we can see that also. Now, the next issue then is, how do we compute current tax? And what is the definition, which I've explained earlier? As you can see here, current tax is the actual amount of tax payable to the relevant tax what? Authority. Okay? Or recoverable if it's an asset to the tax authority in relation to your trading activities of the entities during the reporting period. And this is arrived at by multiplying your tax rate with your taxable profits. If you remember, what we have done in the spreadsheet was to do that. Now, what are taxable profit or loss? It's a profit or loss for a period determined in accordance with the rules established by the tax authorities upon which income taxes are payable or recovered. Okay, and that is that. Now, what does IAS 12 say about recognition of current tax liability and asset? Is that unpaid taxes in respect of current or prior period should be recognized as liability, which we have explained earlier. And when you have paid in excess, you recognize it as an asset. That's only a extreme situation you can have current tax assets. And it can be possible in Nigerian context if the amount of withholding tax deducted from your transaction is far above your income tax that you are liable to pay. In that case, you can seek for tax refund, which shows that you have a current tax asset, or you take a credit against future utilization. But when you know that it might be perpetual in nature, the best thing is to seek for refund. But the reality in Nigeria is that the refund might take some time to get. Now let's now look at uncertain tax position. What is an uncertain tax position? Okay, yeah, you can ask a question.
Yes, sir. Please, I have a question. Is it possible for us to have, because we've considered withholding tax earlier, but is it possible for us to have withholding tax itself, withholding tax credits in the financial statement? And
Yes.
another question is it, what's it called? Is offsetting allowed for deferred tax? Maybe when we have deferred tax assets which exceed the deferred tax liability, can we offset? I don't know if, is it possible to have the two at the same time?
We are not going to be discussing deferred tax today. We are still discussing introduction to that tax, and also we are discussing current tax. There are a lot of discussions that goes on in deferred tax. By the time we cross all of those sections, we will now come to a conclusion on, is it practicable, or under what condition is it possible to offset if it's even allowed in the first case. Do you get what I'm saying now? Therefore, let's put that aside. Let me answer your first question. Your first question is withholding tax credit going to be shown in the financial? Yes. And there are various methodologies to it, but the simplest methodology is that every credit note that is not utilized is shown as a component of current asset under other receivables. Under what? Other receivables. You have withholding tax credits notes there. And you only applied it in the year you want to pay your tax, so that when you file this tax, for example, let me go back to our tax. If you are filing tax now, let's say you want to make tax returns. Therefore, you want to determine, let me come here. Sorry. This is, let me say, tax filing, tax return. Summary of tax returns. For this 2021 year of assessment, which is for 2020 financial year. Therefore, I'll come here, I'll say, estimated current tax payable. Okay? I'll come here, company income tax due. What is my company income tax due or company income tax liability, as the case may be? Because it's due, it's a liability, it's not necessarily immediately payable. Okay, and I'll explain why. I have this. I can come and say, less withholding tax credit notes now utilized.
Okay.
You know, you prepare schedule for it. You can reference the schedule with the number and all sorts of things. Now I can say I have 5,248. Therefore, what is payable now?
5,630.
Therefore, my company tax payable. You know, you only use withholding tax to reduce company income tax. You don't use it to reduce other ones. Now I have my company income tax, which is CIT payable. Is this? This is my CIT payable. Other ones, I'll just come here tertiary education tax, information technology development levy, NASENI levy, FPF levy, and capital gain tax. But capital gain tax now, by the Finance Act of 2021, is payable 2 times a year, every 6 months. I mean, therefore, I come here, every other one, I bring it down here. Okay. This is all what I'll pay. But remember, you are paying it separately into separate accounts. This will be the total statutory taxes that is due for me to pay, which will be reported in my balance sheet. All because this is the only portion I've already paid out of, which is the withholding tax. Okay, even in your balance sheet, even before you pay, you can offset your withholding tax credit note, but most people don't use that practice. You leave withholding tax credits in your other what's it called? In your other payable, and you take the whole liability in other payable, or you offset it if you have a good mechanism to doing that. Okay, that is that. This is now the total corporate taxes payable to FRS. But again, you don't pay it in lump sum, you pay it in each of the accounts because they are different tax regimes. Does that make sense?
Very well, sir. Very well. Thank you, sir.
Okay. Okay. Now let's move on. Now, on certain tax position, because you still be subjected to audits, that can bring about you pay additional taxes, which is usually the practice in Nigeria, or you pay lower taxes, which is very rare. And my experience with FRS is that any year they do audit and you have lower taxes compared to what they can put, they will now put it to zero as if all is, that means they agree with you what you have paid. But the year you have lower than what they can put, even if you have agreement to agree what they have done, they will say you should pay and they can't offset the lower one. But in reality, how it's supposed to be is that when a final position of tax is agreed between the taxpayer and the tax authority after the hula baloo disagreement to agree, the difference has to be adjusted for. And how do you adjust for it? We'll look at it. But before the adjustments, there are implications. Anytime we have overpaid taxes based on the assessments, we'll say you have over-provided for taxes. Anytime you have underpaid taxes, you will say you have under-provided for taxes. But anytime you under-provide for taxes, 2 burdens are added to it. Which means if you have filed tax of 10 million, and audit revealed that it should be 12 million based on disagreement and agreement, the additional 2 million is what we know as additional taxes. And this additional 2 million may come with penalty, which usually in Nigerian context is 10%. And 2 may also come with interest, which in Nigeria is ruled at MPR rate plus maximum of 5%. And given that MPR rate now is 14%, or is it 14 or 15? By the time we have 5, therefore you are coming to 20, 21, or 19, as the case may be. Which then means that the question then is, how do we treat additional taxes or excess taxes? And how do we treat penalty and what? Interest. And take note, Even when FRS has accepted that you overpaid taxes in prior period, they will not pay you interest, neither can you charge them penalty because you did it yourself. It's not their own doing. But anytime you underpay, it comes with penalty and interest, even though waiver can be granted based on various concessions and the requirement of the law. Okay, now the question is this. Let me go back to the example. Or let me use my notes. On certain tax position. This could bring about additional taxes or in extreme situation, refundable taxes, which is where you have over-provided. But when you have under-provided, which is usually the case, you have additional taxes. 2, it could come with penalty, which usually is at 10%. And 3, it could come with what? Interest, which is at MPR plus 5%. Now the question is this. Let's assume the additional tax is 10 million. Penalty is another 1 million. Interest, by the time we factor it, let's say it comes to 19%, let's say 1.9, which means your demand notice to pay additional taxes comes to 12.9 million. This is the demand notice from Federal Inland Revenue Service. Therefore, the question then is this: how do we treat this 10? How do we treat this 1? And how do we treat this 1.9? Who can guide us? Let's start with the 10 million. How do we treat it? How should we treat 10 million? Anything? Now, 10 million found its basis from adjustments we have made to these profits on the premise of disallow, allow, disallow, allow, and all sorts of things. Which that means that it still found its basis from profits. It still found its basis from what? From profits. And if you remember our definition of profit, is still income minus what? Expense. Therefore, in that situation, we are going to treat this 10 million as an income tax. That's the first thing. Secondly, this penalty is to cover for administrative bottlenecks that you have given to FRS in establishing this fact of under remittance of 10 million. And therefore, this will be treated as an OPEX, which is a loss a business loss because this expense is avoidable, probably. But again, the reality of it is that sometimes it becomes unavoidable based on subjectivity and judgment involved. Okay, this is treated as an OPEX, which means a consumed part of your admin, management, and other expenses. Sorry, I should have used blue. As an OPEX, a business loss, invariably, as OPEX. Okay, and how do we treat the final one? The final one, I can treat it if not material to my finance costs, I'm going to treat it to finance costs. I'm going to treat it as an OPEX. Otherwise, usually you can treat this as a component of finance costs or finance charge. Okay, but again, it is also a function of accounting policy. And such should be consistently applied. Take note, and we're going to discuss, okay, I've even given you material and my video recording, which is on demand, on accounting policies formulation. How do you go about making assumptions, judgments about accounting estimates? And how do you treat changes in accounting policies in line with IAS 8? And how do you treat changes in accounting estimates in line with IAS 8? And where there's a thin line between the two, where do you consider it to be much more of changes in accounting estimates? Thereby, accounting changes in accounting estimates requires prospective accounting, which is what we always use in an uncertain tax position, which we're going to use today. Rather, if it's a change in accounting policy, you much more rely on using retrospective application of such a policy. And the cumulative effect of those adjustments will impact on your opening retained earnings. And we also discuss then, in relation with IAS 8, how to make correction for material prior period errors. You can go back to the learning material and the video and other things to more or less refresh your memories. Okay, that is that. Now, additional tax element that is an income tax, how do we treat it? We treat it as if it's a tax of the current period in which that additional taxes was raised. What does that mean? If tax of 2021 was audited in 2022, and financial statement of 2021 has already been issued, and it's come to floor that we have additional 10 million as income tax arising from 2021, which means that in 2022, we are going to adjust our estimated tax in 2022. Let's say our estimated tax in 2022 is 50 million. We will now adjust the 50 million with additional 10 million. As if 60 million is our tax for 2022. Similarly, if our tax in 2021 as filed was 50 million, and in 2022, tax audit was done and it was covered that it's supposed to be 40 million. 10 million refundable taxes, which is considered over provision for 2021, will be treated as a reduction in our current tax of 2022. What it simply means that if our tax for 2022 is estimated at, let me say, 70 million, the 10 million excess from 2021 will be used to reduce 70 million of 2022, thereby arriving at 60 million of our current tax of 2022. And this methodology or approach is what we call prospective adjustments for uncertain tax position, which means the over provision or under provision for taxes of per period in the current period that is not attributed to error will be adjusted against the current period in which that information is made available. The only exception to that is if actually it was attributable to error. And what is error in this case? Probably when you are supposed to add back depreciation, you wrongly inputted the formula that deducted once again the depreciation. And that is the only source of the difference. Therefore, this is a correction of an error, not a changes that arose from the fact that there is differences in interpretation or judgments. And that is a position I'm making you to have understanding of. Therefore, let us now go back in time to discuss this. Now let's look up. On certain tax position, the impact, current and deferred tax amounts may be affected. And we are going to see measure everything in line with IAS 12. Okay, I recognize it appropriately as an income tax, as we have said earlier. But the penalty and interest, as I've said earlier, will constitute asset or liability, as the case may be. And we are going to recognize them rather as an OPEX or finance cost and recognize a liability for them if they have not yet been paid. Okay, therefore, what is the consensus about what's called uncertain tax position in line with IFRIC 23? IFRIC 23 also deals extensively with uncertain tax position or uncertainty over income tax treatment. Now, where tax treatment should be considered collectively, an entity is required to use judgment to determine whether each tax treatment should be considered independently or whether some tax treatment should be considered together. The decision should be based on which approach provides better prediction of the resolution of the uncertainties. Furthermore, assumption for tax authorities examination. An entity is to assume that a tax authority will give rise to examine any amount reported to it and will examine those amounts and will have full knowledge of relevant information when doing so. Also, determination of taxable profits or loss, tax basis, or unused tax losses, or unused tax credit and tax rates. An entity has to consider whether it is probable that the relevant tax authority will accept each tax treatment or group of tax treatment that is used or planned to use in income tax filing. If the entity concludes that it is probable that a particular tax treatment is accepted, the entity has to determine taxable profit or tax loss, tax basis, unutilized tax losses, unused tax credits, or tax rate consistently with the tax treatment included in its income tax filing. If the entity concludes that it is not probable that a particular tax treatment is accepted, the entity has to use the most likely amount or the expected value of the tax treatment when determining taxable profits, tax loss, tax basis, unused tax losses, unused tax credit, and tax rates. The decision should be based on which method provides better prediction of the resolution of the uncertainty. Now, another thing I want you to understand or know is the effect of changes in fact and circumstances that borders on this uncertainty. Now, in this case, an entity has to reassess its judgment and estimate if fact and circumstances has changed. For example, if there have been changes in tax law, or there have been most recent decided cases that more or less provide more clarity with respect to the position we have taken before, and some other things like that. Therefore, all of this are to be taken into consideration. And this position, as defined or spelled out by IFRIC 23, became effective from the period beginning 1st of January 2019. Okay, and today we are in 2022, which means it's already 3 years or 2 years into its existence. Okay, now this illustration will also buttress all what we have discussed about treatment of under provision and treatment of over provision. Okay, Mr. Denny, can you read this illustration and let us look at what solution can we provide in that case? Are you there, sir?
Yes, sir. In 2020, ABC had taxable profit of 100,000 naira. In the previous year, 2019, income tax on 2019 profits had been estimated as 20,000. Tax rate is 30%. We are required to calculate tax payable and the charge for 2020. If the tax due on 2019 profit was subsequently agreed with the tax authorities as A, 25,000 or B, 15,000. Note, any other or overpayments are not settled until the following year's tax payment is due.
Okay, now in this case, what will be your position? When you have underpaid tax of 2020 instead of 25, how do you treat that difference of 5? And also when you have underpaid or you have overpaid by 20 instead of 15, how do you treat that? Now, treating that is as illustrated below. Remember, in 2020, your taxable profit is estimated at 100, and at 30% rate, what are you entitled to? You are entitled to pay 30% of 100,000, which is 30,000. But if you go by A says in 2019, you estimated your tax to be 20, but when tax authority audited and you both agree, it was 25, which means under provision for 2019 will be added to your tax in 2020 as if that tax belongs to 2020, only that you disclose it. And at the end of the day, what you report as current tax for 2020 will be the addition of 5, which is underpayment in 2019, plus that of 2020 to make up 35. But again, this 5 does not include penalty and interest because those funds will have gone into operating expenses and finance costs respectively. Now, this says, what if it is 15 that you ought to have paid, but you have paid 20 based on your tax audit? It then means that your current year tax is 30,000, but you will be allowed to reduce your current tax with your overpayment of last year, which was 5,000, because you overpaid 5,000 in excess of 15. Therefore, it means your tax this year will be showing as if it's 25, whereas it was 30. But it's 25 because you are allowed to utilize your overpayment last year in the current period. Does that make sense, sir?
Yes, sir. Thank you, sir.
Okay. Now, I want you to look at how do we recognize taxes in our financial statements and how do we present taxes in our financial statements. Okay, I want you to read that now for us. Okay, over to you, sir.
Recognition of current tax. Normally, current tax is recognized as income or expense and included in the net profit or loss for the period, except in two cases. One, tax arising from a business combination, which is an acquisition and is treated differently. Two, tax arising from a transaction or event, which is recognized directly in equity in the same or a different period. Presentation. In the statement of financial position, tax assets and liabilities should be shown separately from other assets and liabilities. Current tax assets and liabilities can be offset, but this should happen only when certain conditions apply. One, the entity has a legally enforceable right to set off the recognized amount. Two, the entity intends to settle the amount on a net basis or to realize the asset and settle the liability at the same time. The tax expense, i.e. income, related, the tax expense or income related to the profit or loss from ordinary activities should be shown in the income statement.
Okay. Thank you very much, sir. Now, we're going to look at how do we present income tax in the financial statement. Okay. In this case, what do we do? This is my tax returns. A component of my tax return, that is, if you go back to what we did earlier, all of the current taxes we computed and the likes, you find out that a component of them relates to profit or loss, or significant component of them, which means every profit emanates from transaction that flows from either profit or loss, other comprehensive income, and those that affect equity directly. Now, in that situation, the component of current taxes will be traced, current and deferred tax, which means the component of income tax as a whole will be traced to those that are reported through profit or loss, which is the significant component of them, or those that are reported through other comprehensive income, those that are reported directly in equity, or because they are not reported either through profit or loss or through other comprehensive income. And majorly, some of them are attributable to equity. And we also have those that might arise as a result of business combination, which is acquisition. And this is always common within a jurisdiction where there's a group taxation. But in Nigeria, there's no group taxation. But sometimes, even without group taxation, at least there might be some element of income tax attributable to deferred tax rather than current tax that can be ascribed to business combination. That's that. Now, which means not every amount of income tax we compute, which is a composition of current and deferred tax that will be reported in profit or loss. We need to delineate them and attribute portions to profit or loss as it relates, to OCI as it relates, or to equity as it relates. But mostly, because in Nigeria, some of the entities are not into sophisticated transactions that might have given rise to other comprehensive income. most times, all of their taxes are reported to profit or loss because they might not even have items that are reported to other comprehensive income. Neither do they even have items that impact equity directly, of which has tax implication. And sometimes they might have items that report through other comprehensive income, but of which they do not have tax consequences. Okay, now this also refresh our mind towards how we report or how we calculate our current taxes. Okay, how do we calculate our current taxes? As you all know, we calculate our current taxes by looking at what is our tax base. But again, this is for deferred tax. I won't look at that. We'll come back to deferred tax later. But what is much more important is that I've shown you what current tax is, which is all what we have discussed today, which are the amount payable or the amount refundable to or by the relevant tax authority, in this case, FRS, in respect to current and prior periods, activities of a company in Nigeria. Okay, that is that. Now we have been able to discuss extensively by trying to understand what tax is as against taxation and why we use them interchangeably. We have also been able to establish what are the bases to which tax are assessed or what is the reference point. And this reference point, we have been able to delineate them into those that constitute bulk of it, which are transaction taxes, and those ones that constitute income taxes. And we are also having some that are cross-border, such as withholding tax, minimum tax, excess dividend tax, that more or less we need to analyze further in order to extract the portion that are income taxes and the other portion that may be considered as transaction taxes. And current taxes, we revisited the process of computing corporate taxes, which are the current taxes as estimated. Okay, having looked at various tax adjustments, how we relieve losses and how we absorb capital allowances. Okay, and also we venture into a situation where the amount of estimated taxes are not final, neither are they conclusive because they are still subject to audit or verification by the tax authorities. And where we so agree with the tax authority additional taxes, how do we treat additional taxes? Where we so agree with tax authority that we have overpaid taxes, how do we treat overpayment of taxes? Okay, and where there are penalty and interest attributable to additional taxes, how do we report them in our financial statements? And finally, the entire gamut of income taxes, how are they presented in the income statements? The income component are attributed to profit or loss and presented accordingly in profit or loss. Others are reported in other comprehensive income, and we have those that are reported in equity directly, especially those that arose from business combination. And finally, in the balance sheet, we have told you that you must always separate current tax from deferred tax. Why? Because one, current tax are current item, deferred tax are non-current item. And again, current tax can be current tax assets, it can be current tax payable. Current tax assets is a component of current assets, current tax payable is a component of current liability. Deferred tax assets is a component of non-current assets. Deferred tax liability is a component of non-current liability. And therefore, what we'll look at in our part 2 of our discussion will now be extensively
You are muted, sir.
Okay, what we'll be looking at in our final part or concluding part, not even concluding part, in our next part, which is part 2, is deferred taxes. We'll look at what are deferred taxes. Okay, where does deferred tax come from? Okay, and from there, we'll also look at various requirement principles and guidelines towards recognition of deferred tax. And all of this, we're going to have it in the next part, probably part 2 and part 3, if not more. And at the end of the day, we'll be able to reach a conclusion where we've been able to establish our firm understanding with practical illustrations, especially when we get to deferred tax, we model as much as practicable many things in order to provide better understanding of how deferred tax is computed and how they are reported and presented in our IFRS financial statements. In case there's any question, kindly ask, clarification, otherwise we'll call it a day. Thank you very much. Any question?
I have no questions.
Thank you, Prof. No question from me.
Okay. Thank you, guys.
Thank you, sir.
Yeah, we'll meet next week, God's willing.
Thank you, sir. Thank you, sir.
God bless you guys all. Bye.
Amen, sir. Bye-bye, sir.